Welcome to Tech Money Madness, your daily U.S. stock market podcast, June 19th, 2026. And if you're joining us today, I want to officially welcome you to our daily deep dive. Our mission today is to make sense of a market that just feels like it's being violently pulled in two completely different directions.
Yeah, it's definitely a confusing day on the trading floor.
Right, because, usually when you look at your portfolio or the broader global economy, you expect the symptoms to make some kind of logical sense. Like if you go to the doctor and your chart shows a spiking fever and critically low blood pressure, the doctor doesn't expect you to suddenly jump off the exam table and deadlift 800 pounds.
Now, physiological contradictions like that usually mean something is deeply fundamentally wrong with the diagnostic equipment, or the patient is masking a much deeper trauma.
Okay, let's unpack this because looking at the financial data hitting our desks today, that is exactly the patient we are dealing with. It's this bizarre tug of war. On one side of the room, you have a surging global inflation, new sweeping tariffs, and the severe ongoing economic damages radiating out of the Iran war. So the physical economy looks fair.
Pretty sick, yeah.
But then you look at the other side of the room, and tech stocks and deep learning sectors aren't just surviving. They're expanding by trillions of dollars. They're defying gravity. So to understand how we got to a multi-trillion-dollar tech boom right in the middle of a global macro crisis, we have to start at the foundational layer. What is the central bank doing?
Well, the macro perspective is the bedrock here, especially if you're trying to figure out where to park your money. Today, all eyes have been on the Federal Reserve. Under Chairman Kevin Warsh, the Fed just concluded its first meeting. And what stands out is that they followed the script on interest rates perfectly. No surprises, no sudden pivots to either hike or cut. They just held steady.
Hold on, I want to break down that concept of the script for a second. Why is predictability so critical? Because as an everyday consumer, holding rates steady when inflation is still biting doesn't necessarily feel like a victory.
Right, it doesn't. But it really comes down to how institutional capital operates. Huge funds managing billions of dollars, they don't mind bad news nearly as much as they mind surprise news.
Ah, I see.
Yeah, when the Fed acts predictably, it allows those massive funds to accurately price risk. They know what it's going to cost to borrow money next month, so they can confidently deploy capital today. When the Fed follows the script, it basically removes a premium of fear from the market.
But just because the surface of the water is calm for institutional investors doesn't mean there aren't dangerous undertows for the rest of us. Because I'm looking at the underlying currents in the U.S. labor market right now, and the structural foundation is actually starting to crack. Specifically, we're seeing a significant surge in long-term unemployment.
And that is the hidden trauma in this economy. We really have to separate short-term frictional unemployment, like someone taking a month to find a new marketing job, from what we're seeing right now. Long-term unemployment acts like a corrosive acid on the broader economy.
Explain the actual mechanics of that. Like, why does someone being out of work for, say, 8 months damage the broader economy more than someone being out for 2?
Because of a concept called skill atrophy and network decay. When a worker is sidelined for an extended period, it's not just a loss of current income that they'd otherwise be spending at local businesses.
Right.
The software they use updates. Their industry networks move on without them. So the longer they're out, the harder it is for an employer to justify hiring them over a fresh candidate.
Wow, so they just get left behind.
Exactly. But beyond the purely financial ramifications, there are severe documented impacts on emotional health and family stability. It creates a scarring effect on the workforce. And that takes years, sometimes decades, to heal, which effectively removes productive members from the economic engine.
So we are setting up a world where the macro surface looks fine because the Fed is steady, but the human foundation is eroding, which really begs the question. If the U.S. central bank is acting predictably, why is the global economic picture so incredibly turbulent today?
Well, we have to look beyond our borders to understand that turbulence. The global economy is absorbing a massive supply-side shock, primarily driven by the severe economic damages and trade disruptions from the ongoing Iran war.
And if you're listening to this and wondering why your grocery bill is so high, we saw the devastating mathematical proof of that shock in the domestic numbers today. U.S. consumer prices rose 4.2% annually in May. That officially hits a 3-year high.
Yeah, it's painful.
And if that wasn't enough of a squeeze, wholesale prices, the producer price index, spiked 1.1% in May, which was significantly more than anyone expected.
If we connect this to the bigger picture, let's define why that producer price index, or PPI, actually matters to you as a consumer. PPI measures the costs that manufacturers and businesses pay to create goods before they ever hit the store shelves.
It's an early warning system.
Precisely. It is a leading indicator. If it costs a factory more to make a product today, it will cost you more to buy it next month. And the primary culprit behind that 1.1% spike is a massive, undeniable surge in energy costs.
Because of the Iran conflict.
Yes, the war has disrupted major global energy trade routes and introduced massive risk premiums into the oil and gas markets.
Huh.
Just think about the physical journey of a product. If oil spikes, it costs more to power the factory that makes the plastic. It costs more to fuel the cargo ship that moves the product across the ocean.
And it costs more to fill the diesel truck that brings it to your local store.
Exactly. Those cascading costs are bleeding directly into the producer prices.
Which ultimately gets passed down to you and me at the checkout aisle. But what is completely wild to me, and where I need you to help connect the dots, is how the people in charge of fixing this, the global central banks, are reacting in completely opposite ways to the exact same geopolitical pressure.
It is a stunning divergence in monetary policy. It really shows how fragmented the global economy has become. Take the European Central Bank, the ECB. They just officially hiked interest rates for the first time since 2023.
Okay.
And in their guidance, they specifically cited those rising energy costs driven by the Iran war.
Wait, let me make sure I understand the logic there. If the inflation is being caused by an external supply shock, literally a war-disrupting oil ships, how does the ECB raising interest rates fix that? It's like trying to cool down a burning building, which is the energy inflation, by shutting off the water supply to the whole neighborhood, representing the broader economy.
That analogy hits the nail on the head. The ECB knows they cannot magically produce more oil or stop a war, but what they can do is crush demand.
By making money more expensive.
Right. By raising interest rates, they make it more expensive for European businesses to borrow and expand, and more expensive for consumers to get loans. They're intentionally slowing down their own economy so that people buy fewer things.
Which cools down the demand for energy.
Exactly, preventing those high oil prices from baking into long-term structural inflation. It is a painful medicine.
But then you look across the channel at the Bank of England, the BOE, and they are writing a completely different prescription. They just held their interest rates steady at 3.75%. And looking at the notes, it was a solid 7-2 vote by their committee to keep them on hold. Why is the UK refusing to take the medicine while Europe is voluntarily swallowing it?
Because the UK's localized data is telling a slightly different story. UK inflation actually held steady at 2.8% in May. It didn't spike the way the US or European numbers did.
Oh, interesting.
Yeah, and coupled with that, the BOA is looking at the geopolitical chessboard and currently pricing in new prospects of peace in the Iran war. They're betting that the energy disruptions might be peaking or resolving, so rather than unnecessarily choking off their own economic growth with the rate hike, they're holding steady.
Okay, so we have the ECB slamming on the economic brakes to fight the fire, the BOE coasting to see if the fire burns itself out, and the Fed stubbornly keeping things on cruise control despite the crash in the labor market. Doesn't this complete lack of global coordination make a severe global recession much more likely? I mean, how does a multinational company even plan for next year in this environment?
It introduces incredible friction into global trade and currency markets. When central banks diverge this sharply, it creates massive shifts in capital flows as investors chase yield. And speaking of friction in global trade, we have another major complication to factor into this macro puzzle.
The tariffs.
Right. The U.S. is formally proposing fresh tariffs on 60 different economies over forced labor practices.
Just to report on the mechanics of this proposal impartially, because, our goal here is purely to understand the market impact of the data. This is a proposed 10% duty rate specifically targeting economies that have adopted a full or partial prohibition on forced labor trade. So, from a purely economic standpoint, what is the actual mechanism of a tariff like this?
Regardless of the geopolitical or ethical reasoning behind the policy, the pure economic mechanism of a 10% tariff is that it acts as an immediate import tax.
Okay.
If a U.S. company buys $1 million worth of steel from one of these 60 economies, the tariff means they suddenly have to pay an extra $100,000 at the border. The foreign country doesn't pay it, the U.S. importing company pays it.
And historically, they pass almost all of that extra cost directly onto the consumer.
Always.
So if we synthesize this first half of the deep dive, you have a U.S. consumer already dealing with 4.2% inflation, a surge in energy costs from a war, rising long-term unemployment, and now the potential of a 10% duty rate slapped onto the supply chains of 60 different economies. The physical, traditional economy is incredibly stressed.
It is bogged down in friction. Every single metric we just discussed, inflation, rates, tariffs, war, it all adds friction, making it harder and more expensive to move goods and generate profit in the physical world.
But, and here is the massive pivot of the day. If you completely ignore the physical economy of shipping containers, energy barrels, and grocery store aisles, and you look exclusively at the tech sector, you would think we are living in an entirely different reality, a golden age.
Yeah.
How do we have a booming tech market when the physical market is suffocating?
Because the technological economy is acting like it has achieved escape velocity from the physical constraints of the world. It really is a tale of two economies.
Let's look at the poster child for escape velocity right now, SpaceX. We just got the data that SpaceX is now the 5th most valuable public company in the entire world. They've hit a market cap of $2.73 trillion.
Trillion with a T.
It's an astronomical number. But we have to dissect how we actually arrive at that $2.73 trillion.
Well, here's where it gets really interesting, because the sources we're looking at today are flashing massive warning signs. They explicitly state that SpaceX's valuation is entirely, quote, disconnected from market fundamentals. For the listener trying to evaluate this stock, what does that actually mean in plain English? When analysts look at fundamentals, they're looking at the actual hard math of a business today. Like, how much cash does SpaceX make from launching rockets right now? What are their profit margins?
Right.
When they say the valuation is disconnected, they mean the current revenue cannot mathematically justify a nearly $3 trillion price tag. Investors aren't buying SpaceX for what it earns today. They are pricing in a narrative.
Story.
Exactly. They are betting on a future where SpaceX completely monopolizes low Earth orbit, controls all satellite internet, and dominates interplanetary logistics.
So it's faith-based investing at a trillion-dollar scale. They're paying for a monopoly that doesn't fully exist yet.
Exactly. It's a valuation built purely on absolute future dominance.
But the fascinating thing about this bifurcated market is that you don't have to rely on faith to find trillion-dollar valuations. You have tech titans right now whose massive numbers are actually backed by grounded, real-world cash flow.
Contrast SpaceX with a company like NVIDIA. NVIDIA is currently highlighted in today's data as the absolutely dominant infrastructure player in the AI space. And unlike a purely narrative-driven valuation, NVIDIA is posting a staggering 85% revenue growth.
Let's stop right there. 85% growth for a company of that size is borderline science fiction. What exactly are they selling that allows them to grow that fast in an economy choked by 4.2% inflation?
They're selling the picks and shovels for the digital gold rush, and they're basically the only store in town. NVIDIA designs the specialized microchips, the GPUs, that are required to train massive artificial intelligence models.
But it's not just the hardware, right?
No, the real mechanism of their dominance is their software platform called CDA. Developers build their AI applications using CEA, which only works efficiently on NVIDIA chips. Once a company builds their infrastructure on NVIDIA software, it becomes incredibly expensive and complex to switch to a competitor.
Ah, so they're trapped.
Yes. That lock-in is what creates 85% revenue growth. And in the context of that massive realized cash flow, their valuation is actually considered reasonable by market standards.
Which is wild. And then you look at the consumer side with Apple. Apple is being universally praised right now for something analysts are calling an ecosystem safety premium. Explain that to me. Are investors essentially paying extra for Apple stock just because it feels like a safe bunker during a macro storm?
That is precisely how institutional money is treating it. Apple has an incredibly proven business model with ironclad ecosystem lock-in. Once you buy the iPhone, you buy the watch, you use the cloud storage, you subscribe to the music service.
You're fully in the walled garden.
Yep. They have highly predictable hardware replacement cycles. They know roughly when you will upgrade, combined with a services business that operates on massive profit margins. In a world where the physical economy is chaotic, Apple's recurring revenue feels as safe as a government bond to investors.
And speaking of recurring revenue, the data shows Amazon is actively on track to reach $1 trillion in annual revenue by 2028. Not market cap, which is the value of the stock, but $1 trillion in actual cash passing through their hands.
Because they've established unshakable leadership in two areas: global e-commerce and, critically, cloud computing with AWS. The cloud computing division acts as the backbone for countless other companies, providing a steady stream of high-margin revenue that shields Amazon from the turbulence of the retail sector.
But I have to push back here for a second. What is the underlying tide that's lifting all of these massive tech boats simultaneously? I understand Apple has a great ecosystem and NVIDIA sells great chips, but why is this specific tech sector seemingly immune to the inflation and energy costs crippling everything else?
It comes down to one underlying theme: the deep learning explosion. The projections we are digesting today are paradigm shifting. The global deep learning market is projected to skyrocket from $125.41 billion in 2025 to nearly $2 trillion, $1,963.25 billion by 2035.
Hold on, you just threw a massive near $2 trillion number at me. But I have to ask, is this just another metaverse-style hype bubble? Prove to me this isn't just a buzzword. How does deep learning actually change the math for these companies?
The mechanism driving this isn't speculative hype. It's the brutal reality of enterprise automation. Consider a large corporation dealing with that 4.2% inflation and rising labor costs. They cannot easily raise prices on consumers who are already squeezed. Their only path to maintaining profit margins is radical efficiency.
So they turn to AI.
Generative AI fundamentally alters a company's workflow. Instead of hiring 10 junior analysts to parse through legal documents or write basic code, a company licenses an AI tool that can do it in seconds, requiring only one senior manager to review the work.
So it's about permanently reducing labor overhead?
Yes. The drivers behind this growth are rapid, desperate adoptions of AI to automate tasks that used to require human salaries. And the companies providing that automation, NVIDIA, Google, Microsoft, Amazon, Apple, they are reaping the rewards.
And this is happening everywhere.
Everywhere. Geographically, the U.S. deep learning market alone is expected to expand from roughly $37.14 billion to over $596.02 billion over the next decade. Europe is projected to grow from $31.98 billion to over $451.64 billion. It's a global race for efficiency.
So we have these multi-trillion-dollar projections painting the picture of the next decade. But let's bring that back down from the clouds to today's actual trading floor. If you're looking at your retirement portfolio today, how did these dueling themes, the sick physical economy and the booming tech economy, actually play out?
The daily tape reflects the fracture perfectly. Tech stocks were the undeniable top gainers today. NVIDIA closed up 2.5%, riding the momentum of that incredible cash flow we discussed.
Right.
Apple finished the day up 1.8%, continuing to benefit from investors treating it like a safe haven asset. The money is flowing away from physical friction and into digital scalability.
But not every tech darling survived the day unscathed. On the flip side, Tesla sits among the top losers today, dropping 2.1%. Why did Tesla drop while the rest of tech surged?
It's a stark reminder that even within the tech sector, your exposure to the physical world really matters. Tesla builds incredible software, but at the end of the day, they manufacture physical cars made of steel, aluminum, and batteries.
So they're tethered to the real world.
Exactly. They're vulnerable to the exact supply chain frictions, shipping costs, and consumer loan interest rates that the rest of the traditional economy is facing. Execution and consumer exposure matter.
And if you want to know where the big institutional conviction really lies, you don't look at the percentage gains, you look at the trading volume.
Absolutely. Volume is the footprint of the giants. The volume leaders today read like a who's who of the deep learning revolution. Amazon traded 10 million shares today. Microsoft traded 8 million shares. Alphabet traded 7 million shares.
Just to contextualize that for the listener, when Amazon trades 10 million shares, that's not retail traders on their phones buying fractions of a stock.
No, not at all. That volume represents massive institutional capital pension funds, sovereign wealth funds, giant asset managers rotating heavily into the infrastructure of the AI economy. They are placing structural, long-term bets on who will own the enterprise automation space.
So we've covered a massive amount of ground today. We started with the Fed holding steady, moved into surging 4.2% inflation and war-driven energy spikes, looked at uncoordinated central banks, uncovered a hidden unemployment crisis, and contrasted all of that with a multi-trillion-dollar AI gold rush. So what does this all mean? If you had to synthesize this deep dive for the listener right now, what is the core takeaway they need to watch moving forward?
The core synthesis is that you cannot look at the global market as a single unified organism anymore. We are navigating a deeply, permanently split economy. On one side of the fracture, you have the physical reality. You have severe consumer inflation, a global supply chain damaged by the Iran war, and central banks like the ECB being forced to actively choke their own economies just to survive the energy shock.
That's the fever dream reality for the everyday person buying groceries and paying rent.
Yes. But on the other side of the fracture, you have historic tech stock performance.
Mm.
And importantly, with the exception of narrative-driven valuations like SpaceX, much of this tech boom is driven by very real fundamental growth.
The AI automation.
Right. The rapid adoption of generative AI and enterprise automation by key players is creating a self-sustaining ecosystem of wealth that seems completely decoupled from the struggles of the traditional economy.
Which brings us back to our patient on the exam table. One arm is broken, but the other is lifting cars. But here's the final thought I want to leave you with today, something to really mull over as you look at your portfolio and think about where this is all heading. We established today that enterprise automation and AI are driving trillions in tech growth. And as we discussed, they're driving that growth largely because companies are using these tools to become radically more efficient, which ultimately means reducing their human labor costs.
Right.
But at the same exact time, we established that long-term unemployment is quietly surging, creating hidden costs, network decay, and emotional ruin for the workforce. Meanwhile, you, the everyday consumer, are getting squeezed to the breaking point by 4.2% inflation, new import tariffs, and rising energy costs. So the provocative question you have to ask yourself is this. If the entire strategy of the current tech boom is to build a $2 trillion infrastructure of AI-powered megacorporations that automate human labor out of the equation, but the everyday consumer is slowly going broke from inflation and unemployment, who exactly is going to be left with enough money to buy the goods and services that these AI machines are selling? Are we building the most incredibly efficient, automated factories in human history for a consumer base that can no longer afford to shop?
It's a dark thought, but a necessary one.
It's an ultimate economic paradox. We are building an economy that doesn't need humans at the exact moment humans can't afford to live in it. And navigating that tension is what will define the markets for the rest of the year. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.